Good afternoon, everyone. For some of you, good morning still. It's Paul Vendrinsky here with SIA Wealth, and I'm joined here today with Jeremy Fehr, CEO of SIA Wealth, and we're gonna give a quick overview of the various BMO funds that we sub-advise for, taking a look at how they've been doing recently. We're gonna highlight the last 3 months specifically because that's where we entered back into the markets at the end of April. So we'll take a snapshot of that, and then Jeremy will give his market overview, looking at some of the charts that we follow, some of the sectors we're looking at, seeing why and where we are seeing strength and what may become of those going forward. Before I do so, I just wanted to mention, if you have any questions, type them into the box there under questions, and we'll get to those at the end. And I also wanted to say too, if you guys missed the call we did last month, we described a little bit about some of the enhancements and some of the research and development we've been doing here and how they're going to be implemented in the various funds. So if you did miss that last month, I think at the end here we'll have some contact info to let us know. We'll send you a link to that one too, in case you did miss. We had a few people reach out. So right off the bat here, I'll just jump right into it. We'll start with the BMO Tactical Global Equity ETF Fund. So looking at what we hold in this fund, so again, at the very end of April, the SIA Charts Equity Action Call moved to that green favored zone, which allowed us on a risk to reward basis to move into equity investments and into where we were seeing strength. So in this fund, we hold an allocation to individual stocks. We own an allocation to sector-based ETFs and also broad-based ETFs. And within that as a whole, we have some exposure outside of North America into the international markets. We're seeing some strength, so we own some broad-based names in that. Also own some exposure to Canada through some individual stock holdings. But then most of the portfolio, 59%, is in the US by way of both sector ETFs, broad-based ETFs, as well as individual names. So we've had a lot of diversification in this fund over the past few months. You can see here a lot of the strength, a lot of help has come from the healthcare, the IT, and the consumer discretionary sectors. And you can see by the performance, last month was strong, but over the last 3 months, so this was from late April to the end of July, almost 11% rate of return. So very strong. So we're very happy how we're positioned, and we're obviously participating in the strength. The next one there, that's the BMO Tactical Global Asset Allocation Fund. So the other thing that took place with that equity action call shift was that we were able to overweight equities also. So not only did we move out of the cash equivalents into equities, we also moved to a 60% weighting. And that's what this fund holds. So 60% of this is really the same names you saw in the prior, and 40% in the fixed income market. And again, very diversified. We'll look at fixed income in a second, but the net result over the last 3 months is a gain of over 6%. So again, this is our balanced fund. This is our tactical sleeve that allows overweight, underweight of fixed income or out of equities into safety, and then within those asset classes, the rotation. But we saw a very strong month as well as the past 3 months. The differential between this and the equity fund really came from the bond allocation. And we'll take a quick look at this. Is the BMO Tactical Global Bond ETF Fund, which essentially was flat for the last 3 months. If you can move yeah, there is. Essentially flat for the 3 months. And some of this came, the slight negative there came due to the fact that the US dollar showed a little bit of weakness over the last couple of months. And this fund is overweighted US bonds. The US bonds did perform well and offset most of that currency weakness against the Canadian dollar. But the way things sit still, we're still holding where we're seeing strength, which is basically still on the US side. But if you look at the stuff we own on both sides of the border, it's very similar. Mostly corporate bonds. We're sitting at a longer term duration than we have in the past, around that 11-year mark. But mostly in Canada, the federal, the provincials, and the states treasuries, we do own probably about a 20% sleeve within some of the ETFs into the corporate bond space. So very different than we had a few months ago. And even though we're seeing a lot of backing and support from the various central banks and the governments, by way of the corporate bonds. We're still being cautious right now. That's how the portfolio sits. It's still all investment grade, even on the corporate side, but still a cautionary position on the fixed income side at this point. Jumping ahead to the next one, the BMO SIA Focused North American Equity Fund and ETF, the ZFN. This is our concentrated 15 stock strategy, looking on both sides of the border, Canada and US, and picking where we're seeing strength. And one thing you'll see here is it's a very diversified portfolio as of now. About 4 out of the 15, I think five out of the 15 are Canadian names. The rest are US names. But the sectors, we really have exposure across the board. We have positions in computer software, hardware, metals and mining, electronics and semis, healthcare, utilities, media, and energy. So across the board, there's a lot of strength in a lot of different sectors. And you can see here over the past 3 months, it's netting a return of just over 8%. So very diversified, and we're obviously participating in the strength we've been seeing in a lot of different areas. And then last but not least, taking a look at the Canadian equity. This is the BMO SIA Focused Canadian Equity. We do have a little bit more concentration in certain sectors than in comparison to the ZFN, but still very diversified across a large number of sectors, namely computer software, utilities, but also exposure to construction, metals and mining, finance, transportation, and energy. So again, this is another area that it really is still defying gravity, up over 9% for the 3-month period. So we're very happy with how this is looking. So that was the quick snapshot I wanted to give for the funds. Before passing this on to Jeremy, I just want to mention a couple of things, just as a reminder that this is, for investors, a real tactical sleeve, a tactical alternative. And just so we're clear, as Ted mentions on many of these calls in the past, we are a cheap insurance policy, so that it has the ability for all of these funds to lower risk. And a lot of time that's going to be lowering equity risk when warranted. So what the world has coming ahead here into the fall, a lot of uncertainty, potential volatility with US elections, COVID, how that's going to affect the economy as well as stocks, because there has been a disconnect. We definitely still, monitor a lot of things. We have the tools and the process to make dramatic shifts when necessary. So with that, I'll pass it to Jeremy, who will go over the market update and look at some of the stuff we're tracking. Thank you.
Thanks, Paul, and thanks everyone for taking time to come to our webinar today. As Paul noted, we've got some strong performance over the last few months since going back to the green zone. We've continually are seeing strong outperformance on our benchmarks on most individual days. So relative strength is back in favor here, doing well. And we did protect to the downside during that crisis, initial COVID crisis earlier this year, reducing the drawdown that most clients would have seen. So that worked very, very well for us. The first chart I'm going to do on the market update today is our equity action call. We can see on the far right here, we remain in the green zone. We've had a little bit of movement down over the last month. We've now moving a little bit sideways from that. But again, we're going to be overweight equities during this time frame. Our short-term way that we use now at SIA Wealth Management Inc. Is currently showing near-term strength. So we're in the green zone. We're seeing opportunities with equities, and we'll be overweight throughout our mandates. On the asset class rankings, our second level of analysis, we see no changes from our update in early July. International equity remains the #1 asset class. U.S. equity #2, cash #3, currency 4. Canadian equity remains stubbornly stuck in 5. Bonds in 6, and commodities in 7. So we haven't seen any changes there. We would like to see cash and currency go below Canadian equities. Love to see commodities bump up at least to the 5th position as well before we get into an extremely strong green EAC, where we would be longer term more positive about what's happening with the equity market. So at least over the near term here going into the fall, it appears that things are positive, but we would like to see improvement show up on our asset class rankings over the next couple of months. The first chart I want to show is the SIA charts market equal weight index. A pretty important move happened recently where we see a move above the highs of February. This is very, very important from our point of view because it's showing that the breadth is now improving. For a lot of the webinars that we did during the COVID crisis, we were seeing situations where the indexes were moving, but the equal weight indexes were not. So the rally was not very broad-based. Seeing the EWI, the market EWI now hitting new highs is showing us that there is a breadth coming out. If we look at some of those individual comparison charts, you know, the large caps versus the mid caps versus the small caps, we're seeing now slight outperformance by the mids and smalls. This is very, very positive to us. One of our fears with the green zone, and many of you questioned us many, many times on this, was whether or not we would see this as a short-term rally, really just being fueled by that central bank and government stimulus. It appears that it is moving on to the next level where that breadth is getting wider. So we want to see this continue. There's now room to move technically for this chart up to the 80,000 range from its current levels at 73, 74. So that's good news for us. And there is short-term strength in the SMAX as well. The next chart is the SIA charts market EWI versus cash. Again, this has moved above the highs of February, showing us that equities continue to outperform short-term money market. We do see cash stubbornly stuck in the third position, so there is a lot of cash still on the sidelines. This could be positioned one of two ways, that these people are holding on cash in fear of a market crisis, another correction coming through the fall. But it might be a situation where they get squeezed back into the markets and we see additional equity values rise. Since 2016, the black arrow that's shown on the chart here has seen sideways movement, except for with our steep decline during February and March of this year and parts of April, followed by now we're seeing that trend being breached to the upside. So continued strength in this is something we look forward to seeing. International equity, which is our #1 ranked SIA asset class ranking, is very, very close to hitting its highs. It's past its February levels already and is close to resistance with a breakout being 37,197. We've got a strong SMAX on this and there's room to move beyond it. So our top equity asset class continues to show strength, hasn't even hit a column of O's since the turnaround back in April. This is good news for us on the equity side. It tends to be broad-based. International equity is where the strength is. So we're seeing Europe and more diversified ETFs in our portfolios and continue to see strength there. US equity, which is ranked the #2 asset class, not dissimilar to what we saw with international equity, very high, very close to its all-time highs back to February levels. It's a little bit light on that, but again, is ranked second in our asset class rankings. Strong SMAX on it as well. We're looking for a 48,754 level. So both international and US equity, be great to see these levels breached over the next little while, especially since we've seen the S&P 500 hit new highs. It'd be good to see this equal weight index come along with that for the ride. There's room to move on a breakout here above these highs up to the 56,000 level. So technically this breakout could see additional room to move on a risk reward basis. Canadian equity has been ranked #5 for some time in the SIA asset class rankings, below its highs of February as well. We see that this chart is more of a sideways moving chart with the strong decline in 2016, the strong decline in 2020, but has never really climbed out as we've seen with the US equity chart as an example, or international equity, where it's moving above that longer term trend, which in Canada now goes back to 2011. So it's lagging other equity EWIs, but it is still climbing on the chart. The important thing to note here is, Paul mentioned, there has been weakness in the US dollar versus the Canadian dollar. That has helped on a relative basis. So if we measure the relative performance of Canadian equities versus US equities, in the near term, it has been better, largely based on that currency. So there continues to be more flows of capital going to the US, even with a weaker dollar policy, than there is coming into Canada. So if we're going to see Canada move up, we would need that to reverse, where money flows would leave the US and potentially arrive in Canada. From our last update on the sectors, I wanted to point out here, as Paul mentioned, we're broadly diversified, but it still remains much of the same sectors that are driving that growth, driving that strength within the market. We've got computer software, metals and mining, leisure, electronics and semiconductors, health services, internet, and drugs, all with their own reasons for being successful post-COVID or during this COVID crisis, either online retail or development of that, or drugs and potential remedies and vaccines for the COVID outbreak. So these have all been very, very strong. Of note is specialty retail has now joined the mix. So that larger Amazon trade, where broad-based retailers who are significant online now appears to be moving into specialty retailers. Specifically, we're seeing opportunities in online automotive parts, online jewelry, and then specialty retail products beyond that. So those are areas of growth. The sectors here, what we hope to see over time is that other sectors will join the party up here, not knock these totally out of line, but move them down a little bit and make room for more as the breadth of the market continues to go. Looking at the chart for specialty retail, we can see it's been on a tremendous tear as of late, hitting new highs a month and a half ago. So we've got room still to the upside. Price objective is in that 136,000 range and currently trading around 115,000. So there's room, 10-12% of risk reward to the upside. So that still offers good opportunities for those looking for a sector to invest in. Gold has continued to be a strong outperformer. It's done very, very well on the commodity side, reaching that 2,000 level, and more importantly, that 1894 resistance level. Recently, our next resistance is at the 2200 level, and we continue to see this moving up as more stimulus is moving into the system, as potential players are hedging against some of the risk with overspending and big deficits going across the world. So it's overbought, moved up strongly since May, when it reached the highs of its March levels, and has moved up from that 1600 range up to 2000. So it still offers a good risk reward. A pullback at these levels would not be out of line for this chart. We've seen it in silver already, where there's been a slight pullback. So a pullback here would not be something to panic at. And for those looking for potential opportunities, gold could be there. We certainly see it in our portfolios and have seen success with those. Crude oil, moving up now to test key resistance, 46.06. That would be a strong breakout, would break its downtrend line, which has been in place from the latter part of 2018. The short-term indicators remain strong on it. We've got an S-max of 9, and the last chart signal was positive. Crude appears to be now trading outside of the realm of the politics of crude and the supply side and storage supply created by the Saudis and the Russian governments not too long ago in the COVID crisis. The storage problems that we're seeing that saw crude trade at negative prices is in the rearview mirror. So it's good to see crude trading on its fundamentals. Continued strength here would go in line with economic growth. So we hope to see that downtrend line breached in the near term. Copper, a great chart. I've been showing this as of late because it came out of the left field growing. When we saw the turnaround in April, copper was very, very slow to get moving on this, and I do see it as a strong economic barometer. It took quite a while to get going, but over the last few months has really picked up pace. So we see a new high over the levels of May 2019 at 297 when we saw that key resistance taken out. This gives us upside up into that $3.35 range. So that's great. We'd love to see that taken out as well, but from a risk reward, appears good. So copper has done extremely well and is really adding to that larger view that there's opportunities out there, potentially even inflationary. So other areas, which I don't have listed here, are lumber. Lumber has done tremendously well. There's been supply problems for lumber as well as increased demand as people are doing renovations, presumably in their spare time as they've spent more time at home fixing things up. So we're seeing that happen as well. As Paul mentioned earlier, we've done a tremendous amount of updates to our strategies with BMO, our great partners with BMO Global Asset Management. We've got some of our new technologies implemented into all of the portfolios that we manage with them. Now, we did a webinar a while back, and many people have been asking to hear more about that. If they've missed that, we've got a replay of the SIA Wealth Enhancements, and here's the link here. This is not easy to write down, so we will email you, or you can contact us at siateam@siawm.com, and we will send you the link directly to see the replay of the SIA Wealth Enhancements. With that, I think we're going to turn it over to Q&A. Paul, do we have any questions that have been written in?
I'll just take a peek here. One of the questions was in regard to the international equities we do have exposure to, and that'd be more of a question for me. I guess within the BMO equity and the BMO asset allocation fund, as I mentioned, we do have that allocation to certain international names. We do own the BMO China equity ETF. That's about a 6% exposure. So we have a direct exposure to China right now, but we also own the MSCI, the BMO MSCI Europe High Quality ETF. That gives us some exposure outside of North America also. So I think that answered the question. We don't own any individual stocks, even by way of ADRs at this point. So all our exposure outside of North America is through the ETFs. Let me see here. Jeremy, I think this you were mentioning the specialty retail, Jeremy. So I think we had a question just about specifics for that sector on the best way for exposure to that.
Just bear with me, Paul. I'm just pulling up the list here. I've got a slow internet connection. I saw that question as well. Overstock.com was our top ranked investment in there. They were largely going to online automotive, online jewelry stores, were the areas where that strength was. And I apologize, I am not getting connected in here. So again, we'll probably just do an update. We'll add those to the daily stock report just because I'm having trouble connecting at this time, and we'll highlight some names during this week from our daily stock report.
Okay, and you know what? I think that's about it as far as questions go. I'd just remind everyone that you can contact us anytime if you have any questions after this. Also, as a reminder, we have the SIA Wealth page within YouTube that has a collection of these calls and the past ones we've done in case you've missed any and you want to look any of them up. Unless you have anything more, Jeremy, I would like to thank everyone for joining us here today, and we'll see you next time.
Thanks, everyone.